Term life insurance provides temporary protection for a limited period. The coverage term may be either a certain number of years or to a specified age. Term life is pure insurance protection, with no cash value associated with it. If the insured dies during the coverage term, then the policy's death benefit is payable. If the insured is alive at the end of the coverage term, then the coverage ends, and the policy terminates without value. Because it only offers protection for a limited time, term life is best used for temporary needs or as a stopgap measure until the policy owner can afford permanent life insurance. There are three basic forms of term life insurance: level term, decreasing term, increasing term. Level term insurance. The most popular form of term life insurance is level term life insurance, which provides a level death benefit for the duration of the coverage term. The term can be for a certain number of years, 5-year term, 10-year term, 20-year term, etc., or it can be to a specified age, term to age 55, term to age 65, etc. Example: level term life insurance may provide level face amount coverage for a specified number of years or to a specified age. A $200,000 level 10-year term policy provides $200,000 of coverage for 10 years. The premium for the coverage stays the same for each of the 10 years. At the end of the 10-year period, coverage ends. A $200,000 term to 65 policy provides $200,000 of coverage until the insured reaches age 65. The premium stays the same until the policy ends at the insured's age 65. If either policy is renewed, possible if the policy includes a renewability provision, the premium will then increase to a significantly higher level. Guaranteed level premium term. The most common form of level term insurance is guaranteed level premium term life. These policies guarantee both a level face amount and a level premium for the full coverage term. Indeterminate premium term. Some insurers offer non-guaranteed level premium term policies, in which premiums generally start lower than the guaranteed level version but increase over time and may eventually be higher than guaranteed level term. The most common form is indeterminate level premium term life insurance. Here the premium can increase or decrease between the initial premium and a maximum limit set by the insurer. Renewable term. All term life policies are issued with a termination date. Policies that are either renewable or convertible make it possible to extend coverage. Renewable term life insurance lets the policy owner renew coverage for another term without having to provide new evidence of insurability. This means that even those who have become uninsurable are guaranteed the right to renew the policy. Renewable term premiums are higher than non-renewable term life premiums to account for the guaranteed right to renew even if the insured has become uninsurable. The premium for the renewal coverage is based on the insured's attained age at the time of renewal. As a result, premiums increase with each renewal. Most insurers set upper age limits on renewal of their term policies. For instance, most policies cannot be renewed past age 65 or 70. Annually renewable term. The oldest form of renewable term life insurance is annually renewable term, ART, sometimes called yearly renewable term, YRT. ART policies provide coverage for 1 year, at the end of which the policy owner may renew the contract for another year without having to provide evidence of continued insurability. While the face amount remains the same, premiums increase with each renewal. Reentry option. Some insurers offer a reentry renewal option that lets the owner renew the policy at current rates that are lower than the guaranteed rates that would be used in a standard renewal. To get the lower reentry rate, the insured must prove insurability at the time of renewal or at periodic intervals throughout the policy's term. If the insured is found to have become uninsurable, he or she is permitted to renew at the guaranteed attained age rates used with standard policy renewals. Convertible term. Convertible term life insurance includes a conversion privilege that lets policy owners exchange their term life coverage for a permanent life insurance policy without having to provide evidence of insurability. The new policy's face amount usually matches the expiring term policy's face amount. Typically, the option to convert a term policy to a permanent policy must be exercised at least a year or two before the policy expires. Attained age or original age conversion. Converting a term policy to a permanent policy takes place on either an attained age or an original age basis. Under the attained age method, premiums for the converted policy are based on the insured's age at the time of the conversion. All other factors remaining equal, this means rates will be higher than they were at the original issue age. Under the original age method, premiums for the new policy are based on the insured's age when the term policy was originally issued. Decreasing term insurance. Decreasing term life insurance provides face amount coverage that decreases over time, eventually reaching zero at the end of the term. Decreasing term premiums remain level for the full coverage term. Because coverage decreases over time, decreasing term premiums are less than level term premiums when the policy is issued. While decreasing term life insurance can generally be converted to a permanent plan for most of the term period, it cannot be renewed. Increasing term insurance. Increasing term life insurance is the opposite of decreasing term. With this type of insurance, the death benefit increases over the term to a preset amount or at a preset rate. The premium normally remains level, though at a higher level than either level term or decreasing term. Example. When are decreasing term and increasing term life insurance policies most suitable? Decreasing term life insurance is most commonly used to cover financial needs that decline over time. Mortgage protection is a good example. With a decreasing term policy that matches the declining mortgage balance, an insured homeowner knows funds will be available to pay off the mortgage should he or she die prematurely. Increasing term insurance is most commonly used as a cost of living increase rider on a permanent life insurance policy. Riders are used to add a clause or benefit to the policy. With an increasing term rider, the policy will pay a death benefit equal to the policy's base amount plus the amount that the increasing term insurance had grown to at the insured's death. For your review. Term life insurance provides temporary protection for a specified, limited time that can be defined in years or by the age of the insured. Term life is pure insurance, with no cash value, or savings element, associated with it. Term life is best used for temporary needs or as a stopgap measure until the policy owner can afford permanent life insurance. Level term insurance provides a level death benefit for the duration of the coverage term. Renewable term lets the policy owner renew the policy for another term without having to provide evidence of insurability. Convertible term lets the policy owner convert the policy to a permanent policy of the same face amount without having to provide evidence of insurability. Decreasing term life insurance is most commonly used to cover financial needs, such as a mortgage, that decline over time. Increasing term insurance is most commonly used as a cost of living increase rider on a permanent life insurance policy.
When it comes to life insurance, there's nothing simpler than term life. What's complicated about pure life insurance protection with no bells and whistles? And in fact, its simplicity is part of the reason why term life remains a very popular insurance choice with customers today. Now, the lesson does a good job explaining the basics of term life. Again, it's pure life insurance. There's no cash value element as we see with permanent life insurance. But to help you understand the difference between term life insurance and permanent life insurance, which is covered in a separate lesson, it helps to understand the distinction between renting a house and owning a house. Term insurance is like renting a home. It is protection. It's a roof over your head. You have to pay money every month to live in that home, but you have no ownership in that home. The money you're paying to live in that house is going to the landlord for the right to have that roof over your head. When you move out, the protection ends. And that is the key distinguishing factor of term life insurance that distinguishes it from any form of permanent life insurance. And that is the simple fact the premiums that you're paying are providing for pure insurance protection with no cash value, no savings element to it. This will have a lot more meaning when we talk about permanent life insurance in another lesson. So remember, term life insurance is pure life insurance protection only. It's relatively inexpensive, just as renting a home can be less expensive than owning it. But if you're in it for the long haul, owning the home may be your better option. And permanent life insurance in the long term is probably the better choice. But if it's temporary protection you're looking for, if you're just looking for a roof over your head, term insurance is the way to go.
Okay, so here is our quiz. Andrea bought a $300,000 term to age 55 policy. All the following statements are true except everything is true except life insurance by the entire life. I don't think this is true, but we'll see. Gina owns a $200,000 5-year renewable term, and she wants to renew at the end of the term. In this case, all the following are true except it doesn't say how old she is. Must prove insurability. Let's see, perhaps. Except any time before it expires. I want to say this one. All right. 3. The basic purpose for the re-entry option with a renewable term life insurance policy is to let the policy owner re-entry option with a renewable term life. Renew the policy at lower current rates. Renew the policy at a higher face amount. Convert the term policy to permanent. Renewable term. Reinstate the policy after it has lapsed for non-payment of premiums. Renew the lower current rates rather than a graduated renewal. Maybe. Let's see. Alright, which of the following types of life insurance is the least expensive way to provide mortgage loan protection? I'm saying level term. I don't know. Alright, so I only got one of these right, so I did really bad on this one. Okay, if the policy includes convertibility of feature, Andrea could convert the policy to a permanent life policy, provided she does so before the term expires. So she could convert this to a permanent life policy. That is, everything is correct except that. She cannot convert the term policy to a life insurance policy that provides for her entire life. So that's the wrong answer here. Okay, this is another except one, which means something is wrong. So the one that is wrong here is Gina will be able to renew the policy anytime. I should have picked that one up. I wasn't reading that right. I know that. You can't renew a policy before it expires. Okay, this one I got right. Renew the policy at lower current rates rather than guarantee renewal rates. It must prove insurability at the time of renewal or at periodic intervals through the policy's term. Alright, this one is, the answer is level term insurance. No. Is that right? That's what I had. That's wrong. Okay, so the right one is decreasing term insurance is the correct answer. Level term is commonly used to provide insurance protection when the need for coverage remains a level for any given face amount at the policy issue. Okay, so that's it on this chapter. The next chapter is whole life insurance. We just covered term. Next will be whole life. Alright, so if you need assistance in that, stay tuned.